Big bank earnings out this morning with JP Morgan Chase, Wells Fargo and Citigroup all beating the street's expectations. Rising interest rates helping the bank's bottom lines. Joining us now to discuss is Ken Leon, CFRA Research Director of Equity Research. Thank you so much. So, Ken, give us the lay of the land first. What was your biggest takeaway from today's earnings?
Well, compared to the middle of March, it's really a sigh of relief that our largest banks are durable. They were able to outperform. And also looking ahead, we're still seeing a healthy consumer, and there's a lot of commercial loan activity. So overall for the banks, particularly the largest banks, it looks like an opportunity to gain wallet share and for investors to have higher confidence on return of capital, whether it be dividends or for share buybacks.
It's good to see you, Ken. So on the JP Morgan Chase earnings call this morning, Jamie Dimon was asked about the impact of Silicon Valley Bank collapsing. Let's listen.
Yeah, I wouldn't use the word credit crunch if I were you. I obviously, there's going to be a little bit of tightening. And most of that will be around certain real estate things. You've heard it from, real estate investors already. So, I just look at that as a kind of a thumb on the scale. It just makes the financial conditions be a little bit tighter. It increases the odds of a recession. That's what that is. It's not like a credit crunch.
So it's not a credit crunch. How would you describe the impact of the SVB collapse as we move forward?
It's opportunity and risk. For the largest banks, it's an opportunity to gain share. Where there's risk is for the smaller regionals or community banks that really depend on commercial loans, particularly commercial real estate. This is not a significant percentage of loans for a JP Morgan or a Citi. Wells Fargo actually gave quite a bit of detail out of their total loan book of $933 billion. Commercial real estate's about $33 billion, and office buildings, which is really where there could be distress looking out 1 to 3 years, is under $15 billion. So I think it's framed right, and Jamie Dimon's comments are correct, mostly because they're sitting there as a global bank.
And as you mentioned, commercial real estate there and some of the distress that we could still see, how tight do you think that's going to end up being? We heard some very dire predictions at first when Silicon Valley Bank was going out of business.
Yeah, so commercial real estate really for the largest banks has been mostly lending to either having a property that's a Class A building, having investment grade tenants, not so much risk there. It really becomes an issue as you spread that out to older buildings, Class B buildings, where there's been an increase of vacancies, an increase of subleasing, and lower leasing absorption rates. And again, if we're talking about a disease or risk of a crunch, real estate takes a long time. It doesn't happen in weeks or months, and it will play out. I also cover office real estate, and I could share with you that where there's bigger exposure would be on the leveraging side, or as even what Jamie Dimon said, the refinancing for anyone that still has variable debt that has to be refinanced in 2023 or 24. It's better to do it now versus wait.
And we'll really see that in particular among those regional banks. So we obviously didn't see a lot of direct impact from SVB on this report. Will we see it in the next quarter, or is this more of a next year, 2024 story?
Not for the largest banks. They represent 65-70% of U.S. total bank assets. There was deposit flow into the large from small banks 2 weeks ago. That kind of stabilized a week ago. And again, our firm does really deep dive analysis of all the leverage ratios, liquidity, duration risk for the smaller banks. And we don't think we're going to see a situation like this as magnified as, 3 U.S. bankruptcies coming out of the banks.
And obviously, we still have yet to hear from Goldman Sachs and Morgan Stanley, who will also be reporting earnings. What are your expectations there, and what are you going to be honing in on?
Well, they better say that they have a healthy and a growing pipeline for doing deals in both underwriting and M&A, because certainly the markets are really challenging. First quarter, We did see another quarter where at large the industry year over year did see significant declines, but that's kind of loaded for an upturn. So we're at the trough for investment banking. It will be more than offset by trading, as we saw today, in fixed income, currencies, and even equities. And firms like Morgan Stanley also have strong asset wealth management. This is really why we went from halt to strong buy on both Goldman Sachs and Morgan Stanley back in the middle of March, mostly because we feel at some point we're going to move off the trough, and these areas, they're going to gain market share, particularly with Credit Suisse no longer a player in investment banking.
All right, got to leave it there. Ken Leon, CFRA, good to see you, sir. Enjoy the weekend.